Ladies and gentlemen, good day and welcome to Max India Limited Q2 and H1 FY26 earnings conference call. As a reminder, all participant lines will be in the listen-only mode and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star, then zero on your touchtone phone. Please note that this call is being recorded. I now hand the conference over to Mr. Rajesh Mehta, MD and CEO from Max India Limited. Thank you and over to you, sir.
Thank you very much. Namaste everybody and a very good morning to all of you. On behalf of Max India, a very warm welcome to each one of you for our Q2 and H1 FY26 earnings call. Hope all of you had a good festive season and wish you all the best, for the year as we approach 2026. Some of you not in Delhi, you are blessed. You're not facing the polluted air that we are facing. So stay away for a few weeks is my advice. Today I'm joined by my colleagues, Mr. Ajay Agarwal, the Deputy CEO and CFO for Antara Senior Living and Head of Investor Relations. Sandeep Pathak, who's a CFO for Max India Limited and also legal counsel for Max India's all companies as a whole. Mr. Ishan Khanna, who's the CEO for Antara Assisted Care. Mr. Ankit Kalra, CFO Antara Assisted Care. Shubham, who's part of our IR team, and our IR and advisors from SGA, Brinkle and team. Taking your feedback, we uploaded the result yesterday, so hopefully all of you got time to review them before the earnings call. Before I start, essentially on a consolidated basis, you can see that revenue has grown 15% on a H1 basis Y-on-Y compared to H1 last year, and a quarter basis 6%. It's growth across all verticals, and I will share more details. The other good thing is that all our resident satisfaction scores are holding steady 88%. All our voice of customer scores from care homes, care at home are constant at 94-95%, and age is at 86%, which is one more vindication of how people are experiencing the Antara brand. This quarter was more about making sure that we are able to strengthen execution. As you know, this year our aspiration was to scale up exponentially across our business lines, and we have seen steady progress across the business lines. We have laid down the strong foundation on infrastructure capabilities, particularly emphasizing on driving utilization, improving margins, deepening customer engagement, and strengthening our ecosystem across the three verticals. On the regulatory environment ecosystem front, we have remained quite active in shaping industry standards and policy for our senior care in India, working with bodies like Niti Aayog. In Q2 H1, we received the Early Adopters Award from NABH for care homes. As you know, we have been involved with NABH in looking at the standards for care homes. Also, we received recognition from HQ2S on driving quality culture and products in business. And Dehradun community continues to hold the ASLI Certificate of Excellence audited by Grant Thornton. These credentials are not just badges, but actually reflect our ongoing commitment to compliance, quality and leadership in India's evolving senior care ecosystem. As informed earlier, the rights issue of 124.23 crores was concluded. It was oversubscribed. Thank you very much for your support. 100 crores is supposed to be utilized for Antara Assisted Care, and 21 for general expenses and 3 for the rights issue expenses. We have so far utilized against the 100 crores allocated to Antara Assisted Care about 34 crores as of September 25. With the success of the rights issue and based on the feedback we received from some of you, we also raised 80 crores through a preferential issue of convertible warrants. Half of the proceeds, the partial payment 40 crores is already been received, and the rest will come next year. This will primarily be used for residents vertical for existing as well as future projects. This ensures that we are well funded, for our future growth. We remain committed to deploying these funds quite prudently with clear focus on returns, scalability, and long-term shareholder value creation. As of September 30th, 2025, our treasury assets sit at 310 crores with a consolidated net worth of 467 crores. Coming down to the verticals now on residences for seniors. Our Gurugram Intergenerational Project 360 is fully sold out. Collections are strong at ITD INR 332 crores with a collection efficiency of an all-time high 99%. As a result, Antara has earned a management fee of INR 27 crores so far and till September 25, out of which 8 crores have accrued in the current financial year. With the success of Estate 360 and the overwhelming response we got from customers, we were encouraged to partner in one more project with Max Estates in the same campus. That's called E361. That gives us approximately 1.04 million square feet, about 360 units. The project will be launched in 2 phases. Launch of the first phase expected in December 25. The RERA has been filed and we should get the RERA approvals and therefore launch in mid-December 25. As regards Chandigarh, there has been a setback due to the geopolitical situation in India. The government has reviewed all height clearances for projects which were within 20 kilometers radius of all important airports. Our project was 20.1 from the Chandigarh airport, so that is still not cleared. We are working with the partner to see what else can be done. So no issue in the partnership, but it's the regulatory constraint, unfortunately, given the geopolitical situation. But we have started to then look out for other opportunities in Chandigarh, despite the fact we've not yet received a direction, but still we want to keep our options open and also pursuing now opportunities in Bangalore and in the south. At Dehradun, our operations remain cash surplus and profitable with a revenue earned of INR 6.2 crores for the quarter. On Noida, Sector 150, our OC is still pending. Let me give an update on that as well. So the matter is lying with the Supreme Court. Our hearing is on the 18th. The Noida Authority in the last hearing has presented 3 categories in Sector 150 and 78, 79, which they want to resolve. We fall in Category 2. The Category 1 hearing was done some time back, and we think there will be some favorable orders, but we haven't got those orders as yet. Our hearing is on 18th, and we are hopeful, given the favorable order that Godrej got in the same sector, we should be able to procure the same. So let's see, we are waiting. We've already paid amounts to Noida Authority. All dues have been paid. We've already constructed our responsive obligation of the sports city in proportion. So we're just waiting for the Supreme Court to help us in this matter. The project is, by the way, all ready for possession. You must have seen the photographs in the investor deck. Thankfully, the sales price in the state sector has improved significantly, and we are confident once we receive the approval for the OC and Phase 2, the IRRs will only improve. We remain committed to develop 1.5 million square feet residences every year. That's our objective, and we will do that. On assisted care services, about 490 beds in place now, out of which 340 are operational. 150 beds in Chennai, ECR and Bangalore will be operational by month end. Occupancy, importantly, has improved sequentially from 20% in Q1 FY26 to 25% in Q2 FY26, which signals the signs of acceptance of the concept and steady growth. The revenue in this segment has grown by 1.3x Q-on-Q and 2.1 Y-on-Y. Is now 3.91 crores, and we have now served about 3,000 patients in care homes. The care at home delivered its highest quarterly revenue, 5.24 crores, which is a 1.1x Q-on-Q and 1.3x Y-on-Y in H1, driven by the introduction of high margin services such as critical care and physiotherapy. While margins in Delhi NCR have remained stable, in Bengaluru, care homes have started giving positive contribution margin, improving from -6 to +6, and Chennai also has shown a positive improvement from 1 to 5% in the care at home business. Such results give us confidence the model is working as per plan. Now it is for us to keep on executing. The patient volume in H1 crossed 6,300 for care at home. On AGZ, so far we have served about 5 lakh customers since inception, about 50,000 repeat customers. AGZ achieved a net revenue of INR 20.9 crores. So we're now already at a monthly run rate of 7 to 8 crores already, marking a 1.5x growth Q-on-Q. The H1 revenue now stands at 35 crores, which is about 3.3 times same period last year. We have had a 2.4 times Q-on-Q growth on the offline sales of AGZ products. If you recall, we had said we will now phase out all third-party products, only sell Amtara label products. So that channel also has taken off now. We now have approximately 85 products with 180 SKUs. We already filed 4 patents in AGZ for knee, for diaper and nebulizer. For all our top selling 10, top sellers, we will now introduce slowly interventions to customize them and create a moat around those products. Our ROAS improved to 2, marking a growth of 1.1x Q on Q and 1.3x Y on Y, signifying higher marketing efficiency and improved conversion. We launched 14 products in H1 FY26. 84% of them have a 4+ rating, and 64% deliver a gross margin of over 50%. 40% of our sourcing now, is from China, which further improves the GM, the gross margin. We also did some celebrity partnerships, as you know, with Anupam Kher, which improved our conversion rate, our click-through rate on Google. Flipkart now contributes about 12 to 13% of our marketplace sales, which is a much higher ROAS, so we are glad on that, and conversion rose to 7.5%. And we are in the process of now having more and more influencers, that we will use for promoting our products. We are now coming up with our gut health nutraceutical range. It will get launched sometime in November, December. This is being developed in partnership with a company from Mumbai called Wellbeing Nutrition, and we are on track for that launch. So on a consolidated basis, just to repeat, in Q2, we did 50.2 crores, reflecting a growth of 6% Y on Y. H1, 91.5 crores on a consolidated basis, reflecting a growth of 15%. Consolidated EBITDA at negative 25.3 crores. The focus continues on cost optimization, high utilization, and efficient treasury management. On liquidity, we're at about 208 crores. Our debt of 105 crores has been repaid, so this is net of that debt, and is primarily earmarked only for growth. So strategically, as we look ahead, we want to keep on focusing to make sure we do a 1.5 million square feet and sell the units that we will launch, maintaining high service levels, expanding the assisted care footprint, target 500 beds operational by November end, and then go on to build out the rest over the next 4 years. Scale AGZ to reach, and drive break even by early FY28 or late FY27. Continue investment in brand, technology, talent, and operational excellence, all while safeguarding capital discipline and financial resilience. We are confident that all the building blocks are now firmly in place. Some of the results you can see through the investor deck are now coming out. The sector continues to evolve quite rapidly with more and more players entering. There's strong demand. There's excellent brand credibility for us. You may have seen that many players are now entering the senior living segment, including some marquee names as well. So we are glad that at least the entire category gets a push. So that's been our performance so far. I'll stop here and welcome any questions.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on your touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Harsh from Ionis Alpha.
Hey, Rajat and team. Yeah,
hi Harsh, how are you?
All good, all good. So, couple of questions from my end. On the care homes and AGZ bit, excellent numbers. Just wanted to understand what drove the revenue growth out there. And especially in the care homes bit, how do we see the occupancy levels, going forward, given that, last 2 quarters we have seen a sharp uptick out there?
Yeah. So I think to answer both your questions, I'll ask Ishan to add, but on care homes, you'll find that as the model matures, the occupancy goes up and more beds have come in. So this occupancy will only go up because there is no care home as yet which is on maturity. So this trend we will see for the next 2 or 3 quarters at least of occupancy going up. A lot depends on how we are able to look at our digital customer acquisition journey and our partnership with hospital and doctors. So we don't see a trend of the occupancy going down. Temporarily, there could be a weather, or a seasonal shift that happens sometimes, in healthcare. But apart from that, we see it going up. On AGZ, as I said, we've already hit a steady, rate of about, 6.5, 7.5 crores. And we are pushing all buttons more on efficiency and health metrics now, so that we're able to then, reach the profitability we expect in late FY27. So that's my answer, but Ishan can embellish more on this.
Hi, Harsh. So the occupancy has moved 20 to 25% quarter on quarter. And like Rajat mentioned, there are lots of tailwinds we have now. One of them is also the new beds getting added. There are 2 properties which will go live this month, both one in Bangalore and in Chennai. So that's going to add to the tailwinds. Besides the digital customer acquisition piece through digital marketing, where we see a lot of opportunity and some green shoots in the last quarter, we're also working very strongly on long-term hospital partnerships, which we feel can help in the steady increase in occupancy. We've also done a few internal structural changes in building a sharper focus on sales teams around care homes, and we've seen some green shoots on that as well. On Age Easy, it's frankly all the 3 channels, marketplaces, our own website, D2C and offline, which are fortunately delivering good results. We had reported last time that due to a meta issue, our D2C channel had taken a back seat. So a lot of those issues are now behind us, and we see strong revenue growth there as well. And like Rajat mentioned, on offline, the focus shift to selling only Age Easy products. We are building and focusing on expanding our distribution network through distributor partnerships. And we have now 60 distributor partnerships and presence of Age Easy products, around 600 retailer/chemist touchpoints across North India, and now expanding into South.
Understood. Just a couple of follow-up questions on care homes. Is it possible to break up between the occupancy between long-term and short-term beds? And on 361, when we say that, we plan to launch it in December, does that mean that we start collecting the upfront booking fees from that month itself?
On care homes, first on occupancy, yes, Harsh, we do track occupancy individually for each care home, and the most mature care home right now, which is the Memory Care, is closer to 50% occupancy, and the newest one, which we have, that is Sector 24, is closer to 20-25% occupancy. So we do track them individually. I can tell you that.
As regards 361, yes, the moment we start launch, we will start receiving the upfront collections, and accordingly our DMPs will start getting approved.
Understood. Thanks a lot and all the best.
Thank you.
Thank you. The next question is from the line of Nilesh Jain from Astute Investment Management. Please proceed.
Hi, thank you for the opportunity. So I have been recently tracking your company. Wanted to understand on care home side, if you can please explain me the unit economics. Maybe you can take an example of Gurugram, which has already been existing for I think some time. It will help me understand for the other geographies as well.
Sure.
I'll give you an example of a 100-bedded care home, if I can, or a 50-bedded care home. The way we look at the model is that it should, post going live, I'll first talk about occupancy. It should take us around 4 to 5 quarters to reach 40 to 50% occupancy, and then another 4 quarters from there to go between 65 to 75% occupancy. Our expectation is that in the first 4 to 5 quarters, we should be able to achieve contribution margin 1, that is all direct cost included, break even. And when we move to the 65-75% occupancy is when we should start seeing positive double-digit EBITDA margins from each care home.
Okay. What would be, for average revenue per bed, per day basis, we would be charging?
Our ARPOBs are somewhere between around 6,000 to 6,500. And if you annualize this, we expect that each bed in a care home should give us between 20 to 22 lakhs annually. ARPOB is average revenue per occupied bed, just to clarify.
And this you're seeing at 22 lakhs at full occupancy?
No, this is per bed. At an individual bed basis. A bed going live should give me on occupancy 20 to 22 lakh rupees annually.
Okay. So, in terms of cost, what all costs would be sitting below, if you can help me understand the expenses, which would be the major ones?
Two key expenses are rent and manpower. Rent is around property to property will vary between 15 to 18%. Manpower would be around 25%, and then food, utility, others would be again around 20-25%, and hence our contribution 32% at a steady state occupancy gets achieved.
Okay. Sure. That helps. In terms of your other geographies like Bangalore and Chennai, how has been the trend you are seeing in terms of your revenue per bed? Is it similar to what it has been at Gurugram, or it's comparatively higher?
It is higher, also because the concept of care homes is more mature in the southern markets.
Right.
Also, we do transition care, which is we provide critical care support more in Bangalore, and we've hence seen, and by nature, the average revenue per occupied bed is higher for transition care patients. So we see an ARPOB of close to around 7,000 to 8,000 for transition care patients. There's also an element of TPA, which is available to residents that come in for critical care support, which also helps augmenting the ARPOB further.
Sure. So in terms of occupancy right now, just to understand the patient scenario, what all cases people would actually recommend to stay at care homes, and where is the traction you are seeing?
So there are multiple use cases. Broadly, I will tell you three, and then maybe we could go deeper. The three products that we have under care homes are first assisted living. Assisted living is when seniors who require assistance in activities of daily life but are not really suffering from a specific acute condition but just need to be taken care of because either they are living alone or don't have help and children living separately. They move in and they are normally long term because they need help in bathing, moving around, just taking care of themselves, and that falls under the assisted living category. The second is the transition care, which comes from hospitals and doctor referrals because they are pre or post-operative care with slightly shorter ALOS of around 30 to 40 days. They would come because either they would have had a knee replacement or there has been a cardiac incident, they need care after that, or a neurological episode, again they need care after admission in hospital. And the third product we have is memory care, for which we have one property in Gurgaon, where we have seniors who are suffering from conditions such as dementia that move in. Again, we see longer ALOS there. Average length of stay is longer.
Okay. And lastly, on care home side, before I move to the other part, just wanted to understand how do you calculate occupied bed days and available bed days?
How do we? Okay. So available bed days is the number of beds that have gone live multiplied by the number of months. That gives us the available bed days. And on top of that, the beds that are occupied gives us the numerator.
Okay. So the number we show in presentation is on monthly basis or on quarterly for the 3 months cumulative? The number which we have reported in presentation, 6,765 occupied bed days.
That's for the quarter.
That's for the quarter. Okay. Just moving on to care at home. Just wanted to understand here, how is the pricing? Is it on per day basis, or is it on monthly basis? How is the contract here usually if a customer
Our prices
wants to?
are
Yeah.
published on a per day basis.
Okay.
But depending on potentially how, because every case that we take, we get a medical or a clinical assessment done ahead of that. And
Okay.
based on, and each service is a different price. So if you have physiotherapy, nursing care, GDA, critical care, they're all priced differently. Our prices are normally published, like again, I'm saying on a per day basis. But on the assessment, if there is any long-term support that we feel that's required, we also build packages.
Okay. Okay. So, here, just wanted to understand the unit economics as well.
There's no unit economics at a care at home level. It's as a business, because these are all service businesses.
Right.
So at this point in time, we are at a 20% contribution margin in Delhi and
Okay.
6% in Bangalore and similar in Chennai. So it's a CM1 at this point of time. So that works as a business, not as a unit.
And largely the largest cost here, which is manpower, because this is a
Manpower, right. Yeah.
That's probably all.
So, all these manpower will
Sorry
be
to
on our
interrupt,
payroll,
Mr.
right?
Nilesh.
Okay.
May we
Okay, I'll
request
join
you
back
to
in
join
queue.
the
Yes.
question? Thank you so
Thank
much. The next question, before we take the next question, we would like to remind participants that you may press star and one to ask a question. The next question is on the line of Shivam, an investor. Please proceed.
Hi, sir. I have two questions. First, on the resident side, we were targeting approximately 1.5 lakh square feet every year, and I feel like we are lagging behind. So, how we are approaching this? And second is, we are very small in the care at home. Still, we are growing at around 20%. So, is this below our targets or it's as per our expectations? Thank you.
So residences, yeah, you are right. Because of the Chandigarh, we are lagging now. So if you say 1.5 million for 2 years should be 3. So we have 0.75 of estate 360, 1.1 approximately for estate 361, and zero point 0.4 of Noida phase 2. So had this 1.1, which was absolutely ready for signing, and we are actually engaged, a lot of consultants. We have actually cleaned the site, etc. Also. So this was very much above 3. So yes, I agree. This has been a setback for this quarter, but we are very aggressively working, as Rajat sir mentioned in his speech, for alternatives, and also we have opened another geography so that we don't lose sight of this 1.5 million square feet, and we are confident that we'll be able to recoup this fast.
So 1 million of E360 was already done for this year. So 0.5 is what we look out for.
Correct.
In the next 6 months, we'll be able to announce one project worth 0.5 at least.
Correct.
So we'll catch up. On the care at home,
On care at home, it is a strategic decision to not scale it up, because we feel that this is our core focus is on building and scaling up occupancy on care homes. Care at home for us is supplementary to that, and we have consciously taken an effort to not scale it up beyond that as an independent unit. The focus, as you see also in the results, is on improving the margins and making this business fully profitable.
Okay, so that means the Chandigarh residence is out of the scope as of now, or it can come up?
it can come up. We're looking for alternate pieces of land as well in Chandigarh itself. So it can come up.
Okay. And what about in the future, what are we expecting from care at home? How much growth we can expect?
In similar ranges, Shivang, it should be between 20 to 30% like you see year on year. That's what we are expecting.
Okay. And sir, can you just give some highlights because right now we are not even on the operational level, we are negative, right? So what are we looking at in the next 5 years?
Well, we don't make forward-looking statements, Shivang. Can't do that. But as I said, we are on a growth curve right now, and hopefully the momentum should continue.
Okay, sure. Thank you so much.
Thank you. Before we take the next question, we would like to remind participants that you may press star and one to ask a question. The next question is from the line of Ankit Dharamshi from RNM Capital Trust. Please proceed.
Hi everyone. Good morning and thanks for the opportunity. So my question is regarding the return on ad spend. I think we have done a significant improvement over there and our exit rate is 2.9. I would like to know how much is this sustainable and what is the headroom available further to drive it. And the second question is, what are the other channels? I mean, currently the marketing spend that we have done with Hiten Tejwani and Anupam Kher, it was mostly focused on social media like YouTube and but I don't see too much traction over there because the number of views are quite still low. So what is our broader strategy to ensure that we are able to scale up our reach and optimally further scale up our ROS? Yeah, so that's what I want. Thank you.
Okay.
Hi. So the return on advertising spend that we've achieved till now is only further going to improve because while we have achieved a ROAS of 2, there is a lot of opportunity of improving it both on our D2C or our own website sales as well as on marketplaces. The way we continuously do that is refining our marketing strategies and choosing for efficient channels. And there are multiple open channels. On marketplaces, we do marketing on marketplaces such as Amazon and Flipkart, and we do off-platform. For our website sales, we do through Google, Meta, and through affiliates and partnerships such as GPay, Cred. So there are multiple channels, Ankit, that are open through which we acquire customers. And as this business matures, we have more and more learning and understanding of what is working for us. Just a case in point, if I just look at our exit numbers of Q2, we were close to 4 of ROAS on marketplaces and a very healthy growth on D2C as well. So I can assure you that this will only improve further. Even initiatives such as the celebrity endorsements that you spoke of, for us were not only intended towards reach and engagement on social media, but the impact it was having on business. And as Rajit mentioned earlier, we saw significant improvement of that on the conversions, both on the website as well as marketplaces, which almost increased between 1.5% to 2%. So we keep reviewing our marketing strategies almost on a weekly basis because there's a lot of data that we get from all channels and we keep refining it. So it's only going to improve further. The numbers that you see will sustainably increase.
Okay, thanks for the comprehensive answer. Just one follow-up question. Does quick commerce fit into our strategy? And is there any
quick commerce?
You're talking about quick commerce?
Yeah. I'm talking about quick commerce as a channel.
Yes, quick commerce, there are products within our portfolio that do fit into quick commerce. We have consciously stayed away from quick commerce yet because we felt that we wanted to achieve, as you mentioned, your first part of the question, ROAS efficiency on the existing channels. Because currently quick commerce platforms, they bleed a lot. So we feel that we want to achieve maturity and scale on the other e-commerce channels before we start exploring quick commerce, but it is clearly on our radar. We will go there very soon.
Okay, got it. Thank you.
Thank you. Before we take the next question, participants who wish to ask a question may press star and 1 now. The next question is from the line of Abhijit Maheshwari from AM Capital. Please proceed.
Hi sir, thanks for the opportunity. I'm new to the company but just wanted to understand that you alluded to this 25 crore rupees EBITDA burn. Is it possible to give you the breakup in terms of what is the EBITDA burn in all the 3 businesses, this care homes, care at homes and products?
Give us a second.
Entity was the same, but so we have a breakup of the residences and the Antara Assisted Care as the entity as a whole. So EBITDA is Antara Residences EBITDA positive for the half year of around 1 crore, and Antara Assisted Care is a negative EBITDA of 43.
Balance.
Yes, I understand. I mean, that's there in what you publish. But is it possible to give you, give the breakup in terms of care homes and products? What is the kind of EBITDA one that we are having?
So we have to explain this to you a bit. So the way the accounting works is that we have to come to a CM1 level, which is the direct cost at the particular product level. So if you are doing a care home, that's a care home unit economics. Then when we do a AGG, that's a product economics. From there, you come to a CM2 level where there is a cost which is direct in nature but not directly direct, which is the marketing expenditure, etc. And then there is a corporate cost which comes in, the infra cost, which is divided into all. So we have actually not bifurcated these EBITDA numbers on the three businesses. The CMs can be drawn at the three businesses, but ultimately from the CMs, when we debit the HO cost, etc., the consolidated EBITDA for that particular business is derived.
Can you give an idea?
Got it.
But let's give you an idea. Just hang on. Let's give you an idea of what the numbers could be.
Sure.
So just to give you an idea of the overall EBITDA loss for Antara Assisted Care, approximately 50% of that would be for services and the balance 50% for products. When I say services, it includes care home and at home, both.
Got it. But at home, I'm assuming that since you mentioned that, all the geographies you are making some money over their costs, so it's largely, for care homes only, right?
Yeah, between that, if you would want to split that between care homes and at home, then approximately 70-75% would be for care homes. That's right.
Got it. That's really helpful. Second is a bit bookkeeping question. So, see, when I add up the total revenue of all the segments which you report in your presentation, the total comes up to somewhere close to 30 crores. But when I look at the number in your audited financial, that is around 27 crores. So, just wanted to understand that what am I missing here?
This is the eliminations. The intercompany eliminations are there. So that is the impact. There is the interest cost which is shown as the income at the Max India level on a standalone. But when we consolidate it, because it is coming from a subsidiary, then it has got eliminated.
Got it. Thank you so much, sir. Thank you so much.
Okay.
Thank you. Participants who wish to ask a question may press star and 1 on their touchtone telephone. The next question is on the line of Shiva, an investor. Please proceed.
Sir, basically, how much contribution margin we are making in the AGV business in the exit of the September 2025?
Yeah.
The exit of September, the number for AGG as a whole was 16%.
16%.
1/6.
Okay. Yeah, perfect. And so what is our medium-term expectation from our side, like whatever the target we have set internally?
Yeah.
On CM1, you mean?
I just want to clarify one thing. For the quarter, it was 16%. September exit was 23%.
Yeah, that's what I was expecting because we have a ROAS is much better, 2.9 in the September. Right.
Yeah.
Yeah, perfect. And I'm just asking, like, okay, on the medium term, what are internal targets? Like, okay, what is our ambition? Like, okay, we have to reach to this point as an overall business.
So, Shiva, again, you're asking me to make forward-looking statements. My humble request is we don't do that. We obviously want to make sure, as I said, that by late FY27, AGC breaks even. So you can then, compute backward what the CM and CM2 will be.
Okay, understood. Thank you, sir.
Thank you. Participants who wish to ask a question may press star and 1 now. As there are no further questions from the participants, I now hand the conference over to the management for the closing comments.
Thank you. Thank you, everybody. Really appreciate the questions. Help us, project the business better. In summary, as I said, Q2 and H1 FY26 reflect a very pivotal period. The scale-up was indeed exponential for this year, but we are glad that all the transition we had wanted, execution, foundation setting for scale has been done. We are evolving from a nascent stage business into a more predictable, more scalable, more resilient business. Still lots of work to be done. We are certainly not claiming victory right now, but I think the signs are quite encouraging. The team has done a fabulous job. and hopefully next quarter we should be able to report, more on the progress. Thank you once again for your trust, for your confidence, for your questions, for your continued partnership. Have a great, year ending as well. Thank you.
Thank you. On behalf of Max India Limited, that concludes this conference. Thank you for joining us, and you may now disconnect your line.